The UK is currently home to some of the cheapest stocks in the world. Well, that's according to this Motley Fool article anyway. And I have to admit, I'm quite a fan of some of their articles, so as somebody who also holds a fair amount of beaten up UK stocks, sitting heavily in the red, you would think that this would be music to my ears. But I've learned to treat these articles with a certain amount of skepticism, as we know these outlets love to play both sides of the fence. I mean, it was only a few months ago that they were talking about a potential FTSE crash. So let's take a few minutes to digest this article and see if there actually is some value to be had in UK stocks right now. Looking at the performance of the FTSE 100, which is pretty much flat over the past 5 years, and the wider FTSE 250 down 8% over the same time frame, and then comparing that to the S&P 500, which is up more than 60%, the Dow Jones up 38%, Germany's DAX up 25%, and the Euro stocks also returning just shy of 25%. It is easy to see that the UK has underperformed relative to its peers, but just for the purposes of covering every base, we should also consider other ways that investors might have made a return, because that's not the whole story. Dividends will also play a factor in the overall return, which aren't considered in the numbers that we've just looked at, and actually this is one area where the FTSE 100 can actually hold its own against US markets. The FTSE 100 paying an average of nearly 4%. Compare that to 1.5% for the S&P 500 and 1.9% for the Dow Jones. Clearly, the FTSE does have its benefits, and a strong dividend yield is one of them. Now, even though in isolation that 4% dividend yield does look good, when you consider the 4% compounded over 5 years is still only a return of around 21%. That's still lower than all of the other markets we've looked at have yielded in capital appreciation, and we haven't even taken into account the dividends that they've paid. Unfortunately, no matter how you look at it, the FTSE is underperforming comparative to its peers. So that leaves us with two possible scenarios. Scenario one is that the directors of these UK companies just aren't doing a very good job at putting their capital to work. They're taking company money and they're investing it in new products and new services which just don't generate the returns we need, and the share price reflects that poor performance fairly. Or scenario two, which is what the article suggests, that the companies aren't actually performing that badly. It's just that the market is grossly undervaluing these companies and their future earning potential. The article does try to highlight this by pointing out that the FTSE has a price to earnings ratio of 8.7, which just means that based on the current year's earnings, you're having to pay £8.70 for every £1 of net profit earned. Flip that into a percentage and it's almost an 11.5% return. And even that is a little bit cautious, as it assumes the company won't grow its net profit from year to year. The article also compares this to the S&P 500, which has a PE ratio of 30.7, or in percentage terms, that's 3.25%. Now, although that does make the FTSE look very cheap, I don't like to compare PEs for different markets, as it's not a simple comparison to make. Again, these figures don't take into account future earnings growth, and we know from experience that lots of the companies that make up the S&P 500 deliver incredible earnings growth year after year. In fact, if you look at the companies that make up the S&P 500, you're going to find Apple, Microsoft, Amazon, and Tesla. More technology-based companies which typically grow faster. Compare that to the FTSE, where the main weightings are for financial, energy, and consumer staples, which will never be able to deliver the same rates of growth. Nonetheless, even in isolation and assuming no growth whatsoever, that 11.5% return still looks pretty attractive. So why aren't investors worldwide loading up on UK stocks? Well, Morgan Stanley say that the UK stock market is the cheapest in the world because investor pessimism towards the UK is currently currently high, which you can understand. We're still struggling to come to terms with our new trading relationship with the EU following Brexit, which was expected to wipe out 4% off of UK GDP in the long term. The energy crisis is actually still ongoing, with gas and electricity prices doubling since 2021. And then we've got the highest core inflation and food inflation in the G7. So I get the pessimism because I feel it too. But there are some positive signs starting to emerge that should be a positive catalyst for the FTSE and other UK markets. Firstly, inflation fell by more than expected in June. The Consumer Price Index, which measures the movement in the cost of a basket of goods and services, supposedly representative of general consumer spending, rose by 7.9% over the past 12 months. Analysts were expecting a read of 8.1%, which means that inflation is slowing down quicker than some had expected. Now, some analysts will focus heavily on the fact that this means prices are still going up, and they're just going up slower than they were before, which is true. But you have to remember that in general, we do want inflation. We just don't want as much of it as we've seen recently. But if you look at the month-over-month figures for June, you're going to see that CPI actually only increased by 0.1%. If you applied that same growth to a 12-month period, then that's well within the Bank of England's 2% target. We're also starting to see movement in reforming the UK stock market listing rules. Jeremy Hunt recently said he wanted to make the LSE more than Europe's Nasdaq by attracting fast-growing firms from across the world and giving companies more flexibility to raise even larger sums from their investors more quickly. Boring, I know, but if it's made easier for high growth companies to list in the UK and more investment flows here as a result of that, then that could be beneficial for all companies listed here. Another piece of recent news that is being touted as a positive catalyst for UK markets is the Mansion House pension reforms, which are basically a set of proposed changes to the way that we invest our retirement savings. They include a voluntary agreement by some of the UK's largest pension providers to invest 5% of their funds in high-growth UK companies. The UK has the largest pension market in Europe, worth over £2.5 trillion, but regulation has meant that we invest less of our pensions in higher risk assets such as equities, and instead we opt for the safe option of fixed income bonds. One of the proposals of this reform is that some of the UK's largest defined contribution providers will commit 5% of their assets in their default funds to unlisted equities by 2030. This could release up to £50 billion of additional investment for these companies, but as they're unlisted companies, it's unlikely to have any immediate impact on the main markets, but instead, it's probably expected to accelerate growth for small and medium-sized tech companies who eventually may join the AIM or the FTSE. All in all, I'm still not seeing any huge catalyst that's going to narrow the gap between the FTSE and other markets around the world in the short term. But I do get the point that this article is making, as that 11.5% return does look like good value for money in uncertain times. At the end of the day, you invest in a company in the hope that they will use the capital to generate more money, and that's what these companies are doing. And with a good chunk of those earnings being distributed to shareholders in the form of dividends, at least you know that the money will end up in your pocket. In fact, the FTSE 100 is expected to break its own dividend record in 2024. The bottom line is, if you can invest in the FTSE 100 at a PE ratio of 8.7 like the article suggests, when the 3-year average for the FTSE is 22.9, then of course that has to be considered good value. I mean, sure, the FTSE probably isn't going to jump 20% over the next 12 months, but it probably isn't going to drop 20% 2% either, due to the established, mature companies that make it up. In fact, if the trend is your friend, then we should probably assume a flat market for the foreseeable future. But ever the optimist, you have to hope that over time, the UK economy will stabilise and return to growth, at which point you should see market valuations more fairly reflected and closer to that 3-year average. Thank you for watching. See you next time.